The US labour market is showing signs of slowing, with August non-farm payrolls report expected to add just 75,000 jobs. Unemployment remains near historic lows, raising questions about the Fed's next move. To break it all down, I'm joined in the studio, Kyle Rodda from Capital.com. Good to see you, of course. Talk to us about what we've seen this week and what we're expecting.
A pickup in volatility, but again, stocks bouncing off the lows of the week and basically at record highs going into this jobs data. Effectively, the question here is, to what extent is the Fed behind the curve when it comes to the labour market and easing policy to support it, versus perhaps being ahead of things and being able to ease policy to kind of buffer the economy from what is clearly a slowdown in the US economy. That's raising the stakes for this particular non-farm payrolls print, because if effectively the jobs data shows that the economy is falling off a cliff, that's going to really rattle some nerves. But if you look at the data this week and the data that we got in the last 24 hours, jobless claims lifted, ADP data, which interestingly enough, especially with some of the credibility issues at the Bureau of Labour Statistics now, is being used as a perhaps better barometer of actual economic activity and labour market activity. All of those things are sort of pointing to a modest and moderate softening in the labour market, which investors are basically buying into. So we're at record highs. Valuations are still very rich. There's all these questions about whether we should be up here and how sensitive to shocks we're going to be. But effectively, for now, investors are taking the kind of glass half full mentality. Again, this jobs data though could potentially drive things one way or the other.
What do you think the markets are watching for in particular?
Well, I mean, like you said, the jobs increase is expected to be about 75,000. The unemployment rate is expected to probably tick up to about 4.3%. The interesting dynamic at the moment, and this was actually picked apart heavily in Powell's recent Jackson Hole speech, is that the unemployment rate would probably be a lot higher if it weren't for the fact that there's been some disruptions to labour supply because of some of the Trump administration's immigration policies in particular. So the whole balance here is that clearly the economy is slowing down. That's going to be something of an issue. But because of the balance of supply and demand in the labour market, the unemployment rate sort of suggests that the US economy is notionally at full employment. So it's kind of this very difficult balance of trying to provide that support to the labour market, despite the fact that maybe that there is a little bit of tightness coming through in the labour market from that supply shock, versus also that having an impact on inflation going forward as well, because there is some data suggesting that inflation is getting out of control too. So it's a very sort of high wire act for the Fed. And I think that's why we've seen the market so jittery, because things could really tip one way or the other very easily. Shock
is the word at the moment, I think, to use. Obviously, it's been a crazy year with so many different things happening, different policies coming through as well. It's interesting about the growth slowing. What would you say are the top three factors for that?
Policy is technically, as far as interest rates are concerned, restrictive, and that's one of the big debates at the moment, is to what extent is policy too restrictive from the Fed, and that they should have cut a little bit earlier than they already have and more aggressively. Again, it runs into these issues, and we're all talking about stagflation again at the moment because inflation is still not back to target. So the Fed hasn't achieved that side of its mandate either. The other thing too is that we had seen that kind of trade policy related shock in the middle of the year, which hit confidence quite significantly, and we have seen business surveys come out over the last week suggesting that the impact of tariffs is still not being fully felt in the economy and only starting to filter through now.
Yep. Which we expected, right?
Which we expected
that it would take some time.
Yeah, but the interesting thing is, if you do look at these surveys, we did see what was technically a contraction in growth in the second quarter in the United States. The US economy is rebounding quite significantly, and some of these surveys are suggesting that the quarterly GDP figure this quarter could rebound to about 2.5% on an annual basis, which would be really quite solid. The problem is again, markets are worried about the worst case scenario, that because of these supply shocks, and that's what tariffs are, this is what these immigration policies are, energy policy to an extent as well, inflation could remain fairly sticky and move away from the target, stopping the Fed's ability to cut interest rates to be able to support the labour market, which everyone's kind of focusing on at the moment. Things are looking okay at the moment. Equities at record highs, obviously showing that people are pricing in the best case scenario. But valuations are at about a 4-year high, historically rich. And so in that situation, shocks are going to be amplified, and that's what everyone's kind of concerned about.
It's interesting, earlier you mentioned about interest rates, and obviously President Trump is going to blame any slowdown on the US economy firmly on the Fed and on Jerome Powell. The Fed and Jerome Powell blames President Trump's policies, particularly when it comes to tariffs here as well. Where do you sit?
Well, it's all of the above, really. And so the question becomes, what is at the margins the biggest influence, and over what time frame as well? And in the short term, undoubtedly, it has been tariffs, because if you look at the growth outlook at the start of the year and where the US economy was, it was surging. It was in a fantastic position, actually. There were obviously problems, cost of living and things of that at the margins. But if you look at aggregate, unemployment was low, jobs growth was strong, GDP was running at 2.5% thereabouts. Inflation was slowly moving back to target, albeit I would argue was probably re-anchored in the high twos and away from that 2% target. You got that confidence shock coming through because of tariffs, and that really kind of shook things up. However, in saying that, if you look at it by the Fed's own logic, that the neutral rate of interest, which is where they would argue would be where interest rates should be to keep the economy on basically an even keel, we're still probably 200 basis points away from that. And the most intellectual argument for interest rate cuts obviously has been articulated by Treasury Secretary Scott Bessent, who sort of said, really, if we're going to be running policy to support the economy, it needs to be about 175 basis points lower. So the answer is both. But I think this year, the reason why we've seen a bit of a dip in growth is obviously because of the trade policy uncertainty.
Yeah, very much so. And I think right across the board, what's interesting though is manufacturing jobs, a decline there. And this is something that President Trump has spoken so strongly about, bringing jobs back to US manufacturing, yet despite all the efforts, it's going the other way. Will it bounce, do you think?
Probably not. This is the problem with the tariffs, is that they're quite myopic. And even if you look at the tariffs in the first term, which were far narrower and lower ultimately, is that on aggregate, yes, you got some jobs coming back onshore because you were protecting particular industries. But if you look at the impact downstream, and you're getting through these, for example, this manufacturing survey that we got during the week, higher input costs means lower business margins, lower margins means lower profits, less profits means less investment employment. So on aggregate, you get less job creation throughout the economy. So that's going to be the issue from here. The problem is as well is that, you could probably offset that a little bit. And this was more the Biden administration's approach to things, is that they would spend the money on certain industries to sort of try and crowd in employment and investment. There's two issues with that. One, you're at full capacity, so you're either drawing productive resources from other things to make that thing work, which is kind of a zero-sum game, or you misallocate resources into unproductive things, which to some extent we may have seen that in the Biden administration as well, and it means in the long run growth is less robust, employment's less robust. So this is kind of the catch-22, but to be perfectly frank, I don't think Trump really understands tariffs. He thinks it's a zero-sum game where you kind of whack a tariff on China, the jobs will come back and everything will be okay, and they'll be really, really rich and all those sorts of things.
It's just not working that way.
It never works that way.
What about participation, though? What does that tell us?
The participation rate, the unemployment.
The drop in participation.
This is one I think is much more interesting, because this is where political economy comes into it. To what extent, and we're having this discussion in Australia as well. You saw the immigration rallies on the weekend about, we've brought in so many people over the last few years. Let's not forget one of the reasons why that was done a few years ago was because we were dealing with labour shortages. That's a massive
we'd locked
factor.
out the whole world and Australians from coming back. So there was a huge push from business to obviously bring more people in because there were unfilled jobs.
Yeah, and I think this is the problem with economics, especially when it runs into politics, is economics is a game of trade-offs. So, for example, in that situation in Australia, did you want to run the risk of, lower labour supply coming in, labour shortages, higher wages and possibly inflation through that way, or do you want to have the situation where we offset that because of bringing people in, but that put stress on infrastructure and housing and all those sorts of things, and that sort of created maybe a bit of a cost of living issue in other parts of the economy. The US situation at the moment is that obviously immigration is a concern, very different from the Australian situation because we can control our borders so well. I've obviously spent time in Europe recently. The States is a similar situation. You get a lot of illegal migration, and that does disrupt society in a number of different ways, and it leads to a lot more illegal employment as well.
It feels like they're all having the conversation we had 15, 20 years ago.
Yeah, well, I mean, that was a bit of a hiccup more than anything, right? I mean, I have this argument with my friends from overseas all the time, is that, we kind of sometimes lecture people about this sort of morality of migration, illegal migration, but we have the toughest borders in the world and we have a giant moat, right?
Yes.
We can keep people out. Going back to the issue with the United States, there is that kind of question: to what extent should strong border policies be implemented? Should people who are more or less working within the country, we'll call it for lack of a better term illegally, should enter the labour market and have an influence on that? Obviously that has a benefit to business, that also has a benefit to broader parts of the economy in many respects, but you do have to ask, to what extent does the government have a role in protecting the jobs of everyday Americans? That has a negative impact on the labour market and growth, but again, there is trade-offs there.
Yep, and when you have someone like President Trump throwing little bombs here and there every day, it can certainly have a big impact. Always appreciate your time, Kyle Rodda. Thank you.
Thank you.